unless the Parent Plus loans have been consolidated by July 1st, 2026. And then there's some other steps you need to take, but I want to finish this consolidation bit first. You are never going to be eligible for any income-driven plan, ever. So anybody with Parent Plus loans today, they have to consolidate. So that and do it in a time frame that ensures that the consolidation is processed by July 1st, 2026. Which means, to be safe, you really need to apply to consolidate by the end of this month.
Hi, everyone, and welcome to the MEFA Podcast. My name is Jonathan Hughes, and that was our guest on the show today, Betsy Mayotte. She's an old friend of ours and a frequent guest. She's also a nationally renowned expert on federal student aid, particularly loans, and she is the founder of the Institute of Student Loan Advisors. And so we are going to be talking PLUS loans today. And why are we going to be doing that? Because there is a really important deadline for PLUS loan borrowers to consolidate their loans in order to be eligible for income-based repayments. So otherwise, they're going to be losing that ability. If they don't start that process soon, and they don't get that done by the deadline, which is July 1st, you'll never be able to do that again. And we'll also lose out on the chance to have these loans, these PLUS loans, forgiven through the Public Service Loan Forgiveness Option Program. So also, for folks just getting their very first financial aid offers from colleges, they're going to be trying to figure out how to pay a balance due. They also need to know that PLUS loans are now capped, and capped for the year and capped for a lifetime. There are lifetime limits associated with PLUS loans now. And so we're doing this show on new PLUS loan realities and how parents and students should think about their moves in the future. We'll be talking about a few other things as well. Well, I will be back after our talk, so now let's get to it. Thank you for being on the show, Betsy Mayotte, founder and president of the Institute of Student Loan Advisors, a frequent guest on this show, and always, whenever we want to do a show that centers around federal loans, whether that's federal student loans or PLUS loans, our first thought is to always have you on the show. And again, know how busy you are, so thank you for making time to be on the show today. So
I love talking about this stuff.
So actually, my first question is, what has been keeping you busy lately?
You mean other than an historic blizzard? Because that,
yes, other than that, yeah.
That kept me busy.
That was, you were right in the middle of that, right?
Oh, yeah. Jim Cantor was here. It's not, you're in the worst of it if Jim Cantor from the Weather Channel decides to set up shop
okay,
a mile and a half down the road from you. But anyway, so, I'm glad that you asked what's keeping me busy lately. I have frantically been trying to get the word out to Parent Plus borrowers about the changes, because as you and I have talked about before, arguably Parent Plus borrowers are going to be the most negatively impacted by the changes around HR 1.
We wanted to get this show out as soon as possible because there is a deadline coming up for PLUS. It's an important one, right? So you mentioned that you were trying to get those word out, so I'll give you the floor to do that.
All right. Dear listeners, I'm going to warn you right now, this is going to be one of the most convoluted, confusing things you may ever hear me say. And I've done my best to try to curate my words to make it the least convoluted and confusing as I can. This is the best I've been able to come up with. So, one of the big things about HR 1 is they made significant changes to payment plans.
And just in case anybody's not sure, HR 1 is?
The budget bill that was passed last summer.
Okay.
Parent Plus loans, in and of themselves, are not eligible for any plans that are based on income. So if you have high debt and lower income, and or if you're a Parent Plus borrower who's working for a nonprofit or government employer and are pursuing public service loan forgiveness, you need to be able to access plans based on your income. Today, the way to do that is to consolidate. what HR1 did is said, unless the Parent Plus loans have been consolidated by July 1st, 2026, and then there's some other steps you need to take, but I want to finish this consolidation bit first. You are never going to be eligible for any income-driven plans ever. So anybody with Parent Plus loans today, they have to consolidate. So that and do it in a time frame that ensures that the consolidation is processed by July 1st, 2026, which means to be safe, you really need to apply to consolidate by the end of this month. Now, normally consolidation only takes around 60 days on average, but we can't guarantee that, and nobody can control the time it takes to process, which is why I'm saying to be safe, you really need to apply by the end of March. Now, in addition to that, after you consolidate, you can never borrow another federal student loan in your name again, and that includes a consolidation on or after July 1st, 2026. Because if you do, they're going to take away your current eligibility for income-driven plans.
I didn't even think about that part.
Yep. If you are a parent who has Parent Plus loans today, and you were counting on the income-driven plans to make the plans affordable, or because you were pursuing PSLF, not only but you still have kids in school. And you're like, okay, but then how do I pay for future child's education? You're going to have two options. One is hopefully there's another parent who can borrow the future loans, and that way the existing loans won't be contaminated, so to speak. The other option is private loans, which, you got to be careful with private loans because many private loans don't have any lower payment options at all. And in most cases with undergrad, the parent does have to co-sign, therefore be equally liable for that. Now, I know MEFA has private loan programs, and I know that there may be some flexibility with those, but I'm just saying broadly, private student loans, people just need to approach with education and caution. But anyway, getting back to the Parent Plus loans. So again, if you have Parent Plus loans and you want to preserve your ability to utilize a plan based on income, by the way, another reason for that, maybe you don't need an income-driven plan right now, but you plan on retiring in the next couple of years, that might be a reason that you want to preserve your ability to use an income-driven repayment plan. So in addition to consolidating by July 1st, meaning apply soon, so it's done by then, you also are going to be required to make one payment before July 2028 on the plan called income contingent repayment. That's your open sesame key. After you make that one payment on ICR, you'll then be eligible for the lower cost income-based repayment. I told you it was convoluted, right?
Yeah. So let me get this straight. So this is for parents who have Parent Plus loans, who want to get on an income contingent repayment plan, in order maybe to to take advantage of public service loan forgiveness, or just to be on that plan. They need to consolidate by July 1st.
Meaning it's processed by then.
Yes. It's processed by then. And then after, so that's the first deadline they have to worry about, is that July 1st, 2026 one.
Right.
And then after that, they have to make one payment on that income contingent repayment plan, which they have 2 years to do. Is that right?
Yep.
Okay.
They have to make that one payment under ICR by July 2028. Now, listen, ICR for most people is the most expensive monthly payment.
Oh.
So if you're doing the loan simulator tool, or we're about to have a new calculator on the TISLA website, and you see the amount of your ICR payment and go, oh my goodness, I can't afford that. You only have to afford one payment. And then at that point, you'll be able to get on IBR, which is, again, for most people, a lot cheaper. Or you'll still be able to use graduated repayment or extended repayment. And they'll be forever grandfathered. At that point, they will forever be grandfathered into income-based repayment if they ever need it, as long as they don't borrow again.
As long as they don't borrow. Because if you borrow again, it's over. You're a new borrower. Is that right?
If you borrow again, your Parent Plus loans, consolidated or not, will only be eligible for what's called the tiered standard plan.
Mm-hmm.
And that plan is not based on income or expenses or anything else. And it's not PSLF eligible.
So how does someone actually do this? So let's imagine someone's hearing this for the first time. They want to do something about it. How do they actually go ahead and consolidate?
Studentaid.gov. And they could apply for ICR as part of that process to get that one payment out of the way. If they want to get that one payment out of the way right away. But yeah, studentaid.gov, they just apply online. It's pretty simple. One other thing to mention is all the income-driven plans, they base the payment off of the borrower's adjusted gross income, assuming they're using a tax return as proof of income, which is what's recommended.
Mm-hmm.
Now, if the borrower's married and they file their taxes jointly, they're going to use both incomes in the calculation.
Mm-hmm.
So if you're worried about that ICR payment or even your future IBR payment, you might want to wait to apply for that until you can file your taxes separately. So at least they're only using your income and not both incomes in the calculation.
Is there anything else that you want to mention to parents who are thinking about doing this other than do it soon?
Well, some other changes with Parent Plus loans are for future loans.
Mm-hmm.
They're reducing the amount you can borrow. You're only going to be able to borrow $20,000 a year per dependent undergraduate student and a maximum of $65,000 per dependent undergraduate student. So it's super important to budget for the whole college career now instead of just doing what a lot of families do, which I get is, all right, let's just get through this year. We'll worry about next year. You can't do that anymore.
Yeah.
Because you might run out of funding. And then, of course, again, with this for those borrowers that already have Parent Plus loans and really need the ability to access lower payment options, there's all that rigmarole that I just went over with you.
Yeah, because there's 2 new payments, right? And I think maybe should we just go over that again, just in case someone's, let's say they're not worried about, consolidating or anything like that. Let's say if somebody's just going on, they're in the middle of their, financing their child's education, they're borrowing the plus. What options as far as repayment are going to be open to them, because they're going to be borrowing new loans, so they will only be eligible for none, just none at all?
They're going to be offered a standard plan, and that's it. The term of the plan will be based on how much they owe in total, and that's it. And even a situation where they may not think they need a lower payment option in the future, and they still have to borrow. I still want these people to consolidate and have the other parent borrow the future loans, because sometimes life can throw you a left hook. So you might not think that you need lower payment options in the future, and I hope you don't.
Yeah.
But boy, to me, it's like going without insurance.
And what about the loan limits? Are they going to be subjected to the $20,000 loan limit if they're midway through their funding their?
So there is a grandfathering for all the new loan limit changes. So if the student is actually enrolled in a program as of June 30th, and there was a prior direct loan taken out for that program, then they're going to be able to borrow at the existing limits, which there aren't any existing limits. They could borrow up to the cost of attendance minus other aid for the lesser of 3 additional years or until the student should have completed their program, whichever is less.
So the other part of this, and we've just been going over it, but that makes this timely is that loan limit piece, because we know that a lot of parents who this is their first time going through it are going to get that financial aid offer, and and be looking to finance some of that. And we know that the Plus loan, is a popular loan for people to take. So again, I just wanted to stress that yearly limit, but even more importantly, the aggregate limit, right? So once again, it's $20,000 per year, and how much is it for the aggregate
It's
per
actually,
student?
we need to be calling it a lifetime limit now.
Okay.
But it's 65,000.
Right. So if you are like you said, be mindful of the entire degree, right? If you're thinking about borrowing plus and you're doing the math, however much you're borrowing times 4, if that exceeds 65,000, you want to be careful about how you borrow, right?
That's right.
What are there other options, really? I mean, you mentioned private, but is that really it?
There are other options. One is to have the child attend a lower cost school for the first 2 years, like a community college. And that's something, this is not a new recommendation. 70% of undergraduate students change schools or majors before they finish. So going to a lower cost school or community college for the first 2 years, first of all, if that student ends up changing majors or changes their mind on what their dream school is, you haven't spent a lot of money on those first 2 years. You know what I mean? You haven't, the sunk cost isn't as high at that point. But even if they don't, you've saved a lot of money by going to the lower cost school for the first 2 years. Just make sure that whatever the dream school is that they're going to transfer into will accept the credits from the first institution. The first 2 years of undergrad for most programs, you're all taking the same type of credits. You don't really get into the credits that are important to the major until the junior and senior year. So that's one way to make sure you don't run out of federal money. The other way is to have the student live at home so that the money's not going towards board at the school. Have the student attend less than full time, although this might be a good transition to the proration question I think you were going to ask me. And work and help contribute to the cost of the tuition so you can pay more out of pocket rather than putting it all on loans. Of course, now there's new rules. I know you haven't asked me the question, but I know you were gonna.
That's okay. Yeah.
There's new rules starting in July of 2026 that if the student's not attending full time, the school's required to prorate the amount. They can't get the maximum amount of the loan. They have to prorate the amount of the loan that they can get for that year.
So, okay, so then, how do we think about that as far as, so if new undergraduate students are going in and they know they're able to borrow $20,000 through the plus, but they need to be enrolled, they need to be thinking about whether or not they're going to be enrolled full-time or half-time, et cetera, to see how much of that plus they're actually eligible to receive.
Yeah.
Is that right?
That proration rule, the only folks that really worries me are what we tend to call non-traditional students, which they tend to be older adults that already have families and work and only go to school. A lot of single parents, for example, and they can go to school part-time, but they need the full loan amount or they're not going to be able to afford school. Right. So that's who I think will be really negatively impacted by this new proration rule.
And does that roughly work out, if you're a half-time student, you get $10,000 versus $20,000, or how exactly does that work? Or is that known yet, really?
It's a pretty straight percentage.
So given those limitations in mind, I mean, knowing that Parent Plus loan borrowing is going to be limited, and there's going to be more people looking for other funding options. How should families be looking at those options, and what are some resources perhaps that folks can use to make the best decision for them as far as what they do end up borrowing if they go that route?
So I don't give recommendations for specific entities. It's one of
Sure.
our commandments at TISLA, and it ensures that we remain neutral. But there are tons of tools online that helps you compare different loan products with each other.
Mm-hmm.
But I will caution people that a lot of those tools, they only generate results for the lenders they have agreements with. So don't just use one tool. And you also want to make extra sure that you read all the terms and conditions. For example, do they have lower payment options? How long can you defer the loans while the student's in school? If you're an undergrad, but you plan on getting a master's degree, are you still going to be able to defer the loans then? Is it a fixed or variable interest rate? If it's variable, how high can the rate go? Will you be required to make payments while in school, even if it's just interest only? Which, by the way, I would recommend people do. Are there co-signer release programs? And if so, how difficult are they to obtain? If life gives you a really bad left hook, so you become disabled or worse than disabled, can the loan be discharged? So those are all really important things to look for when you're shopping around for a private student loan or something different. It could be state loans too. The state loans. I think institutional loans might be making a comeback where the school is the lender. So, but my advice applies to all of those categories.
And so I guess we'll finally get to Grad Plus now because, as you said, the Grad Plus program is being eliminated. So there won't be any more Graduate Plus loans beginning next year. Is this also a hill rather than a cliff? That is, if you're in the middle of your grad program,
right.
Can you still continue, or
the grandfather rules are the same way? As long as you're enrolled as of June 30th and have taken out a direct loan of any kind prior to that, where it was dispersed prior to July 1st, you'll be grandfathered in for the lesser of when you should have been done your program, or 3 years. So, for example, if you're in a 2-year master's program and you should complete in another year, if something happens and it ends up taking you longer, you're still only going to have 1 year left of Grad Plus.
I guess I would finish just by asking about one other thing, and it's sort of an outlier given what we've been focusing on, but that is the public service loan forgiveness buyback program. Is that something that you can discuss, or?
Sure.
Okay.
PSLF buyback is something in regulations that says, listen, if you were in a deferment or a forbearance while you were working PSLF eligible employment, and you realize that if you, instead of taking that deferment or forbearance, had been on an income-driven plan, those months would have counted for PSLF. Down the line, you can go, hey, let me know how much I would have paid during those months if I had been on an income-driven plan instead of this deferment or forbearance. And I'll give that to you in a lump sum, and then you go ahead and count those months. That's what buyback is. Now, you can't apply for buyback until you have on the books, you've certified 120 months of eligible employment, including those months that you're going to be trying to buy back. You can't buy back periods where the loan was in an in-school status. You can in-school deferment, and there's a difference between the two. You can't buy back periods of default. You can't buy back periods that happen prior to a consolidation. But in general, most deferments and forbearances, assuming you haven't since consolidated, you'll be able to do buyback for. Now, with that said, right now, buybacks are taking 12 to 18 months to process. So for some people, applying for buyback because they've hit the 120, but still continuing to make eligible payments, and then seeing which one gets you over the finish line first, is the strategy that people are using.
Okay. Okay, interesting. We are gonna go ahead and get this out as soon as we can so that we can let folks know in time what they need to do in order to take advantage of that consolidation opportunity before that goes away. Before we go, though, is there anything else that you would like to say?
Just because it's timely, for people that are stuck in the save limbo, you might have heard that last week the courts dismissed the case. There was a settlement agreement that we were waiting for the courts to sign off on between the Department of Ed and the plaintiffs. And the settlement agreement basically said, we're both on the same page now. We don't think save is lawful. Well, the court looked at it and went, well, wait a minute. Our job as a court is to field disputes. You guys aren't disputing anymore, so we're just going to dismiss the case. And that threw everything into turmoil. So there was a lot of speculation of, well, wait a minute, if the case was dismissed, then isn't the Department of Education going to be forced to let people back on save, at least until 2028 when Congress got rid of it in the law? Well, Missouri, which was one of the original plaintiffs, they filed an appeal to the court saying, wait, you should not have dismissed this case. So I thought we were going to get an answer to that appeal on Wednesday by close of business, and I haven't seen a thing. So this is unprecedented territory. There's a bunch of different scenarios. The short answer is, because I think it would be a whole other podcast to talk about what those potential scenarios are. And I don't know how useful that would be anyway, because it's all speculation. While there's a non-zero chance that save could come back briefly, I think it's real close to zero. I think that's incredibly unlikely that save will come back. But again, it's not a non-zero. So I expect we'll at least have a small update in the next week or so, finding out if the court's going to accept the appeal or not.
Okay. Well, we'll be on the lookout for that, and I'm sure we'll have you back on to discuss further developments. But thank you so much for being here and for help getting the word out there. Hopefully I can help you do that, and people will get on that payment plan if they need to.
Awesome. All right,
Betsy.
Till the next time.
Okay. Bye-bye. All right, thank you, Betsy. It's always a pleasure to have you on the show. There's no one else better to talk about these things, and we're really lucky to be able to work with you. So, folks, if you liked what you heard in the show today and you want to hear more from us on planning, saving, and paying for college and career readiness, well, then follow the show, and you can do that wherever you find your podcast. And please remember to leave us a good review. I would like to thank our producer, Sean Connolly. I'd like to thank Lisa Rooney, Lauren Dans, Christina Davidson, AJ Yee, and Meredith Clement for their assistance in posting the show. Once again, my name is Jonathan Hughes, and this has been the MEFA Podcast. Thanks.